Okay, if you're self-employed and you've tried getting a real estate loan before, you know it can be really challenging, largely because of income. If that's you and you want to buy real estate, you want to refinance real estate, you want to expand your real estate empire, whatever it might be, check out this video. I'm not going to show you just one, not two. I'm going to show you 5 different ways you can verify income and possibly qualify for a loan to purchase or refinance real estate. If that's you, check this video out all the way through. Okay, you're a self-employed borrower and you want to buy real estate. This webinar, this video is for you. I'm going to show you 5 different loans, guys. But before we get into the loans, let's talk about what a self-employed borrower is. Self-employed to us is somebody who owns a business, either your own business or you own part of a business, typically at least 25% or greater, or perhaps you're an investor and typically an investor in real estate. Any of those individuals, if that's you, qualify for being self-employed. I do want to emphasize, you do need to prove that you own the business. Typically, we get a business license and you need to own it for 2 years or longer. So business license with the county, state, wherever you have the business license with, is typically okay with that. If you own real estate, you don't need a business license. You just need to show that you've owned real estate, and potentially even 1 year there can work. But you need to be self-employed. But generally speaking, the challenge for more self-employed borrowers is income. So let's dive right into it here. The typical way that we verify income for borrowers and self-employed borrowers in particular are 2 years of tax returns. Remember, you have to be self-employed for 2 years, so we're going to get 2 years of tax returns. This is typical for conventional loans, jumbo loans, FHA loans, that kind of loan. It's also typical for this other world of lending that we're going to be talking about today, which in the mortgage industry is called non-QM. Okay, what does that mean? Okay, let's just take a break for a minute here. What does non-QM mean? Who talked about this before? Well, it's this. Back in 2010-ish, the Consumer Finance Protection Bureau, the CFPB, who oversees and sets rules and stuff for mortgages these days, established some guidelines for loans, which they called qualified mortgages, QM mortgages. A qualified mortgage, I'm going to make this very simple, is basically a conventional loan and government loan. Technically speaking, they don't even meet the guidelines, but the CFPB allows them to be in the guidelines for the time being for a qualified mortgage, QM. Loans that are outside those guidelines are considered non-QM or non-qualified mortgage. The guidelines can include things such as debt to income ratio, and clearly how we verify income is one of those guidelines, and so on. So if you don't fit over here in the QM world, you may fit over here in the non-QM world. Doesn't mean you're not going to be able to get a loan. These are long-term loans, 30-year, 20-year, 15-year loans. Fixed rates are available. 5/1 ARMs are available. Interest-only loan products are available. There's a wide variety of loans here. Owner-occupied, non-owner-occupied. Non-owner-occupied, lest I forget to say this, do oftentimes have a prepayment penalty. Usually that can be bought out to zero. The rate's higher if you do so. Sometimes you'll elect to keep the prepay because you're going to keep the property for a long enough period of time, it doesn't matter, and the rate is lower if you have the prepayment penalty. Owner-occupied doesn't have a prepayment penalty. You don't even need to worry about there. All right, let's dive back into this. Okay, 2 years of history is the typical way that we verify income with tax returns. There are problems with that, however. Let us say that you have what we call declining income. You made more income the last year or the prior year than last year, and so the underwriter sees declining income. They're going to have a concern about that. At the very minimum, you're going to write a letter and explain why, and if it doesn't satisfy the underwriter's concern, we may not use the income at all. Could be she may use the smaller income for the last year and qualify you that way, and maybe that doesn't give you enough income. Normally, it's an average of the 2 years, guys. We want to see it kind of even between the 2 years, or maybe increasing income. We don't like the declining income. And of course, if you're a self-employed borrower, you're going to write off every little expense that you possibly can, right? Right. So that works for you from the tax perspective because it lowers your taxable income with all those expenses put in there. But lower taxable income is also lower qualifying income for the loan. Get it? You're not going to get as much loan here. So maybe 2 years tax return doesn't work for you. Well, how about 1 year tax return instead? Remember, you have to be employed for 2 years, self-employed for 2 years or longer, but potentially we'll only use the last year's tax return and not include the previous year because maybe you had a banner year last year, year before that wasn't so great, and you want to use just 1 year. By the way, that can work in the QM world over here, conforming mortgages as well. So let's talk about that if everything else fits for you there. But for sure, there are programs that are just designated for this particular kind of loan in the non-QM world. We use just 1 year tax return, look at that income, if you qualify with the income, and remember on these things, we use the net income, but we will add back what I call non-cash expenses. Typically, that means depreciation. It may mean amortization. You may have a capital expenditure, an expense that you only do once every 5 years or longer. Might be able to add that back in, but that can be really tricky, guys. So just understand. But that's typically how it's done. So let's say 1 year tax return still doesn't work for you. How about bank statements for income? Yes. If you're self-employed, we can use potentially 12 months or 24 months of either personal bank statements or business bank statements to verify income. The way that works is this. If it's personal bank statements, we're going to look at all the deposits that flew through there, that were deposited through there over the last 12 or 24 months. We're going to take out any deposits that don't make sense to us, that are fishy. For instance, transfers typically don't work from one account to the other. We're not going to use those. Anything that's obviously not income, like a return or something like that, that's a deposit in your account, we're not going to use. We're going to use the valid deposits. We're going to take the total of those for the 12-month or 24-month period, divide that by the number of months. If it's your personal bank statements, that's your qualifying income all by itself. If it's your business bank statement, we're going to go a little deeper because we know that there's expenses associated with the business. Hence, we're going to take some kind of an expense factor, maybe as high as 50%, maybe greater. It really depends on your business and you and what you tell us, but let's use 50%. Let us say that you have $20,000 a month average deposit going through your account after we pull out the deposits that we can't use, and you have a 50% expense factor. That means you have $10,000 a month qualifying income for the loan. It's that simple. So that's one way to make we work with bank statements. What? It still doesn't work? You mean you're not going to use 1 year tax return and bank statements don't work for you? You still aren't able to verify income? Well, it's okay. We're a little over halfway through that. Let's keep on going here. There are a couple methods we're going to look at here that just may work for you in verifying income and still being able to get a loan to purchase real estate. Okay, you didn't like the previous 3 ways with bank statements and tax returns. How about a profit and loss statement on your business? That's correct. It can be either self-prepared by you, the business owner, over the last minimum of 12 months, or it can be prepared by a CPA. If it is self-prepared by you, you're typically going to have someone, probably a CPA, basically put a stamp of approval on that profit and loss to let us know that it's a valid profit and loss statement. But it's not audited. This is just a self-prepared profit and loss that makes sense for your business. If that doesn't work for you, let me introduce you to what we call the simple loan. How about if we just use the income off the subject property as qualifying income for the loan? This is non-owner occupied only because it's income off the property for rental properties, 1 unit to 4 unit properties. And here's how it works. We're going to use the market rental income as defined by the appraiser, who's going to give us the market rent on the appraisal when we get it back, or maybe by the tenant you have in there with the lease agreement. If the lease agreement is higher than the appraisal, you're probably right. We're probably going to use the market rent, unless you can show us over the last 12 months that that tenant was making that payment to you. Then we'll probably use that income as your qualifying income. Then we take a look at the payment for the mortgage: principal, interest, taxes, insurance. If there's homeowners insurance, we're going to throw that in there. Anything associated with the payment on the property, and that payment can typically be not greater than the income on the property. That's the simple version, 1-to-1. Income is equal to or greater than all of that payment. Okay, so as you can see, there's more than one way to verify income if you're a self. The point is, if you have questions on these loans, reach out, let us know. We're happy to chat with you about them. Talk about hypotheticals. We can talk about what kind of interest rate, with what kind of credit score, what kind of down payment is needed, and all of that kind of stuff. Hope you learned something here. We hope to hear from you. Thanks for listening. Okay, we're back, and there you go on one simple little slide, the 5 ways to verify income if you're a self-employed borrower. 2 years of tax returns potentially. If that doesn't work, how about 1 year tax returns? If that doesn't work, let's use some bank statements, potentially 12 to 24 months of business or personal bank statements. If you don't like that, and you can prepare a profit and loss statement, get it stamped by a CPA, we'll accept that. Well, if that doesn't work and you're buying a rental property, we'll use just the income off the property. It doesn't get much simpler than that, guys, does it? If you have questions, reach out to us. There's some names and contact information for you. We're licensed in Washington and in Hawaii, licensed in more states than that coming, so let us know. We may be able to help you out. We're part of a Bay Equity. There's some legalese for you. Glad you were able to check us out today. Thanks much. Talk to you later.